the dust is settling on the Fed's second rate hike of this cycle. Calling it a cycle is generous, to say the least, but I'm going to switch my screenshot. We'll come back to these charts in a minute. Technically, we've got some big events occurring, especially on bonds, bond prices and yields. Big movement. A lot of the big movement, I have to say, is being, I would say, exaggerated by technical factors. We'll come back and have a look at the euro dollar as well, which is just touching down on levels not seen since the very beginning of last year. That's 2015. But check out the chart first in terms of what has definitely for sure changed, and that is US interest rates, which have gone up. And this was 100% expected, so this isn't a big deal at all. But yeah, when I say it's generous calling this a cycle, they've managed to take interest rates just 50 basis points higher across this 12-month period. If you look on a 10-year chart, you can see that we are still really, in the grand scheme of things, flat down on the very bottom of the collapse in rates that we saw after the crisis. But look, they hiked, okay? But that wasn't, as we said in detail in the briefing beforehand, that wasn't what was important. It was actually the communication about next year that's key. So here's the dot plot matrix. And what we've seen is dots being shifted higher. Remember that what happens here, all 17 Fed members put a dot on this plot describing where they think interest rates will be at the end of each year. Okay, so the red dots were the September dots, and the blue ones, that's the update that we got last night. So as you can see, for 2016, the rate hike was absolutely unanimous. Every single one of the 17 members all plotted their dot at one rate hike. And so we're in a range between 0.5 and 0.75. The upper bound of the new range is 0.75. Rates shifted higher by 25 basis points. So that was unanimous. 2016 now falls off this chart. As we head into 2017, obviously, that end of 2016 is behind us. We know what rates are at the end of 2016 now. So it was more about 2017 and then actually the longer run. But what you can see here is dots shifted higher generally across this spectrum. So for 2017, what we've seen is, everyone down at the bottom end of the range really shifted up one. And what this has meant, and I guess the big takeaway here, is that the Fed are telling us that they're going to hike rates 3 times next year. Before last night's meeting, the Fed, via their dot plot, were telling us they were going to hike twice. Now, for me, I don't think this is significant. I think that's what most people expected. So I think it was hard for the Fed to not move this higher, given how financial markets have begun shifting their growth and inflation expectations for 2017 as a result of a forthcoming Trump stimulus package. So 2017, dots have shifted up 1. 2018, they've also shifted up 1. So basically each year, on average, we've seen the expected year-end interest rate being 25 basis points higher. And I guess, if you want to be dramatic about it, the longer run, so what it means here by the longer term, that means where will rates top out in this cycle? They also went up by 25 basis points. So essentially all that's happened here is that over at least a 3-year period, if not 4, if not more, who knows how long this cycle is going to be, but basically over a 4-year period, rates are going to now be just 25 basis points higher per year. Now, if you think that's significant, then I think you've miscalculated. A 25-point difference in rates in the end over such a long time is negligible. But it's for now, here and now, of course, markets have been obsessing about this rate hike for months and months and months and months and months, if not years, in fact. And so, of course, it's dramatic. And what we've seen is actually some pretty big movement. And as I said a minute ago, a lot of this movement has been exaggerated by technical factors. Let's start with bonds, where we've really seen the biggest move of all. This is US 10-year. I'm just going to actually, just bear with me. I'm just going to tidy this chart up. Let me just get rid of everything and start again. What's been happening over the last sort of few weeks, and this is a weekly chart, and we're looking back into 2015 here. Ultimately we traded down to test the end of 2015 low. This was around about, or post-election, if you like, as we dropped sharply as we started pricing in a Trump stimulus package that would increase growth and inflation. Then we traded down to test the summer of 2015 low, and that's where we got consolidation. It hasn't been clean around there, but what's happened after last night is an absolute categorical drive down through, putting to bed that level from back in 2015. And if I just show you, if I move this chart slightly further back, we can add another line, which is this one here, which is actually maybe my camera's in the way of that, hang on. Let me make this a bit clearer for you. On the downside now, I'm going to add a line in here because we also broke the summer of 2014 low, and then ultimately we've got the 2014 low, and if you like, it's actually the 2013 and 14 double bottom, which is really the next target technically. That's right the way down at 122.22. Now, from a yield point of view, definitely important, because what's happened here, as prices have dropped sharply last night, we've had a big blowout and a proper break up through the 2.5% handle for a 10-year. Okay, so we're at levels not seen for almost 3 years here for the 10-year. However, we actually saw more dramatic movement on the shorter end of the curve. What we've seen is the curve, that's the US yield curve, flattening because the short end rose faster than the long end. All yields increased. It's just the shorter end being more sensitive to rates, central bank rates, that is, moved more. So with the 5-year, you've actually got the 5-year moved 14 basis points higher, and the key thing about that technically is the 5-year yield has broken up through 2%, and that hasn't happened since April 2011. So the 5-year yield is at a almost 6-year high. The 2 years even more dramatic, in that shifted up and finished up at broke up through 1.25%, and the 2-year bond now trades at the highest it has on a yield basis since August 2009. So the big movement here was definitely on the bond market space. You got some liquidity issues here, you got some technical factors exaggerating it. I mean, I personally think this dot plot move, come on, it's absolutely nothing, and should have been expected. So I'm surprised at just how big the movement here is in bonds, but I guess there is a real fear that as we get into 2017, you're going to continue to see a lack of liquidity on the buy side of longer duration bonds, and people are just a little bit concerned about some kind of yield spike, and so perhaps the hike came and then the dots moved higher, and people are just trying to get ahead of any kind of spiking scenario next year by generally trying to rotate out of this asset. That's kind of what it's all about. Now, if we look at, so certainly bonds sold off sharply. That was a no-brainer. The dollar then strengthened, and what's important about the euro dollar technically, just be aware where we are right now. This is a weekly chart. Be very conscious of the fact that the 2015 low is at 104.63. That's on a continuation chart. We've just bounced off that. We're just testing now actually the November, or it's actually December 2015 low, which is at 104.90. Do bear in mind, if I go to a 1 month chart, just take this back even further, then this is very important down here, because, sorry, just let that load up, because this is the lowest we've been. Well, you've got to, in fact my chart, it does go back that far, right, you've got to go back to 2003 to find the last time that the Eurodollar futures market moved below 104.63. So if we do go below 104.63, we are looking at a over a 13-year low here. So the dollar strengthened. If we just look, I'm going to come back to the charts in a sec. Let's just kind of sift through some more of the detail. So obviously the dots moved. Let's look at the Fed statement itself. So this is looking at the statement, and it's tracking the changes that were made to the statement that they issued in the previous meeting in November. And first thing to say, that there's quite a bit of change. This is more change than normal. I guess the big factors were, so the committee highlighted the considerable pickup in inflation. So that's this line here. Market-based measures of inflation compensation have moved up considerably. So that's actually, when the statement came out, that one word right there, considerably, that's pretty hawkish. I'd say that's more hawkish than people were expecting. That's why you got those initial moves. But they kind of try and dampen that by saying, so they've moved up considerably, but still are low. Okay, so they try to just dampen that word slightly there. So I'd say that's probably the most important word in the entire 500-word statement there, considerably. They noted a decline in unemployment. They crossed out a whole bunch of stuff down here. And they replaced it with, in the view of realized and expected labor market conditions and inflation, the committee decided to raise rates. And then the stance of monetary policy remains accommodative, thereby supporting some further strengthening in the labor market. So that's an important word there as well, some, and again that's hawkish. So they're not looking for further improvements, they're looking for just some more strengthening. There's incredibly subtle changes, but mildly more hawkish. So I'd say the statement has probably gone a little bit further than people thought towards the hawkish side. Okay, that's not, remember what we were saying in the briefing beforehand? That's very typical. You get a hawkish statement and then Yellen turns up in the press conference and tries to dampen it with some dovish comments. So what did Yellen say? Ant sent you out this document from Danske Bank, which is a pretty good overview of kind of what's happened here. So what did Yellen say in the press conference? And so her dovish, and actually she said some hawkish stuff and some dovish stuff, as is typical. The dovish bit was, she said that the changes to the dot plot were really very tiny. And I couldn't agree more with her, but markets haven't really agreed with that. I would say market reaction is over-exaggerated, but Yellen is definitely right. The dot plot changes are really very, very tiny. Okay, that was her dovish comment. She then made an interesting comment, which was really just backtracking from something she said at a speech in Boston a month or so back. So she said that I never said that I favour running a high-pressure economy. She said something, a bit of a throwaway comment back in November. She basically said that she had no problem with letting the economy run hot for a bit. What that means is implying that she's happy to keep rates low for longer, even if it does mean inflation gets a little bit too high. We'll happily put up with a period of inflation that's slightly too high in favour of being cautious and making sure that we're not hiking too soon. She's kind of backtracked from that, so if you like, that was a little bit more hawkish, that comment. She indicated that the Fed has not fully taken Trump's fiscal plans into account, which could, and this was a hawkish comment here, which could result in further Fed hikes than currently indicated by the dots. So that's quite hawkish, definitely for her. She said explicitly, though, to reverse and contradict herself, she said at this point that fiscal policy is not obviously needed to provide stimulus to help us get back to full employment. So she's saying there to Trump, don't be too aggressive here, don't overdo it, we're actually doing okay as it is. Anyway, so there are the kind of comments. Just scrolling down a little bit more detail. Let me go down to some charts here. 1 second. So here's looking at the dots again. And just on the right then, and let's zoom in a touch on this, the right hand chart's looking at markets in terms of what markets are pricing. And as you can see, obviously everything's shifted higher as we've gone, as we're looking out. So markets are now pricing rates to be, they're pricing one hike by June of next year, and by the end of next year they are pricing, hang on, what's this scale? End of 2018. This scale doesn't make sense, actually. I'm not sure what the y-axis scale is here. It doesn't say. Or, sorry, number of hikes. Sorry, I was thinking this was the interest rate of the Fed's interest rate. It's not. They're talking about the number of hikes. Apologies. So one hike by the summer, just over 2 hikes by the end of the year. So markets are only pricing 2 hikes next year. Obviously, the pricing has gone up here, but the Fed have just told us 3. So actually, for once, or not for once, for the entire period of the last few years, we've had markets pricing in less hikes than the Fed have been indicating. Moving down, something of note here on the chart on the right. This is the first ever time in this entire period that the longer run dot plot moved up. This is showing you how the longer run dot has been moving over the last 5 years, and it's been revised consistently lower and lower and lower and lower and lower. This is the very first time that the Fed members collectively have revised up their longer run rate. So that's just something of note. Here's a look at the unemployment rate forecasts on the left and the inflation rate forecasts on the right. With regards to unemployment, they revised down their 2017 forecast to 4.5%. They also revised down their 2019. Okay, they kept 2018 unchanged. They think unemployment's going to flatten at 4.5% for the next few years. On the inflation side, something that may be a surprise, and this was dovish, they didn't revise up their inflation forecast. They kept their inflation forecast exactly the same. So that's slightly dovish. But go back to the chart. I mean, overall, well, actually, no, sorry, one more slide here, which is an important thing to note going into next year. Forget about yesterday's meeting now. Of course, we're going to quickly start focusing on, well, when are they going to hike next? And be aware that the Fed members are changing next year, as is always the case. We get members rotating off the committee. Only 10 vote at any one time. There's 17 members here. Only 10 are voters, and these are the greyed out boxes. They're the voters. Just note what's going to happen, because George, Mester and Rosengren, the big 3 hawks, they're rotating off the committee, and only one hawk is rotating on, and that's Harker. The point being that the committee in 2017 is quite a lot more dovish than it was in 2016. So 2017, the voting members will be more dovish, which perhaps means we may not get 3 hikes. We might only get 2, which is what markets are pricing. Anyway, ultimately, who knows? I mean, it's all a little bit academic, this. Ultimately, we got to wait till Trump gets into office and see what he does, and then see what effect it has, and only then the Fed can judge on what to do next. Let's move back to charts. So, yeah, just be aware of some of these big levels, especially on the euro-dollar. 104.63 is the 13-year low set in March 2015. That was just as the ECB's QE program began. Okay. So what's happening elsewhere then as a result of these moves? Well, it's a tricky one for US equities. Not so much tricky for Europe. They're loving this cheap euro. Check out what's going on with the DAX here this morning. We've punched up. Actually, the DAX is now trading up the high, making new highs for the year. If we look at a daily chart, extending its run, and if you go to a 1 hour chart, just zoom in a bit, just as I've been speaking. We briefly took out, last night's high. We've pulled back a little bit again now. But the DAX has made a new high for the year this morning. So that's a cheap euro helping out some of those German exporters. But if you're looking at the US, well, this is the opposite. In the end, the S&P sold off. US equities sold off their incredibly elevated levels, it's got to be said. And it's going to be interesting to see what the Fed do next year, because the strengthening dollar and indeed now rising yields, that has a tightening effect on the economy on its own. And so it'll be interesting to see if the Fed are able to deliver more hikes. Is the economy going to grow faster off fiscal stimulus, or is fiscal stimulus just purely going to offset the monetary tightening and you don't get any more growth? This is the thing. There's definitely uncertainties about whether fiscal stimulus can deliver an acceleration in growth. But ultimately, in the end, it was a real mess for the S&P. If you want to zoom right in on the action last night, let me just go back. It was, as I was saying yesterday, it's normally the case trading equities off this kind of event's the hardest. And we definitely went lower, but it wasn't straightforward. The pivot acted pretty well. We broke it off the rate hike news. Then it was resistance, traded down to S1, bounced back to the pivot, then we broke S1. And then it got a bit messy. So I guess the pivot levels did quite a good job of defining the movement, but it was it was very choppy. Some of the currency moves and the bond moves were much more unidirectional. Dollar yen up through the roof, trades above testing the 118 handle this morning. Cable dropped sharply and trades down in the 125 region now. Just on cable, we do have a Bank of England meeting today, but let's be honest, it's irrelevant. They're not going to do anything. They're not going to change anything. They're going to remain pretty neutral. We did have David Davis, who's very much a hard Brexit man, seemingly falling more into line with the Chancellor Hammond by suggesting that some kind of interim deal is perhaps the way to go. So we've got a bit of a soft Brexit comment from a hard Brexiteer, which should be sterling strengthening, but it isn't, because the dollar has strengthened more as a result of what happened last night, if that makes sense. Commodities suffered off the back of dollar strength. Check out oil here, which dropped quite sharply, although it's trying to clamber back higher now. Gold also dropped sharply off the back of the dollar strength and the idea the Fed are going to hike more times. This move's been just a bit of a grinder ever since we broke 1200. When was that now? 3 weeks ago. It's just been, I guess, that move last night, technically taking us through 1150 is quite important. And if you're looking on the longer term, technically now, this does open the door a little bit. I mean, there isn't really anything in terms of key support anywhere near here. Obviously 1100 would be psychologically significant. So there we are. Let's focus on today now. I'm going to go back and show you the economic calendar. Other than the Bank of England meeting, there's actually a lot going on data wise, and just as we've already had a lot of manufacturing data. So this is preliminary December manufacturing numbers for Europe, and what's happened is the German number has edged higher and actually beat expectations. So German, and this is something else that's boosted the DAX, of course. So German manufacturing PMI at 55.5, better than the expected 54.5, and a nice tick up from the November reading. So that's the German number. The European number has just been announced, and that was also better than expected at 54.9. So decent numbers on manufacturing so far. We got UK retail sales at 9:30, Bank of England at 12, US CPI. These are final readings for November. These are at 1:30. We've got the Philly Fed manufacturing number also at 1:30, and the New York Empire State manufacturing number. Jobless claims as well. Then we got some housing numbers at 3 p.m. So quite a busy afternoon data-wise, with the Bank of England in there as well at midday. But the Bank of England event, there's no press conference. This will just be at midday. A decision on rates will be unchanged, of course, and then the minutes from the meeting. And really, I guess we want to just see from the minutes, do they indicate, are they going to end QE in quarter one, which is what we're expecting them to do. Okay, so that'll be it. So it's just thinking technically, it's like the fallout from last night. Make sure you're aware of some of these levels. Have these markets moved too aggressively or not? Bonds and the dollar are the key, and just keep your eye for euro dollar, particularly on that 104.63 2015 and 13-year low. Okay, all right, that's it for now, guys. Enjoy the session.